You know, these days, I feel like I am back to my engineering college days again because I am currently studying for my NISM exam. All my preparations are done. The exam is on Sunday, coming Sunday, 10 o'clock in the morning. So, just 3 days remaining. I will just keep doing my revision. So, I feel like I am in college these days. I did my engineering in electronics and telecommunications. I am an engineer graduate. Then I worked with Infosys for a period of 1 year as a software developer. I myself did not know why did I join the company, but as my friends were joining, I said, okay, I will also join, no problem. But then I came out within 1 year. This was long ago. Then I completed my MBA in finance, and then I completed my CFA. So I have studied so much in my life. I sometimes wonder, when will studies stop in my life? My mentor, Mark Minervini, he did not even finish high school. So sometimes I wonder, why do we study so much? But, anyways, that was my little lecture on what is going on. Exam is on coming Sunday. All of you have been sending me your best wishes, and I know that your best wishes will protect me. Okay? I will do well in the exam. I will keep you posted. Coming back to our trading strategy, one of my YouTube subscribers or one of my students, uh, she messaged me. She was buying a particular, she was planning to buy a particular stock. And I realized that there is some confusion regarding the buy price. So that is why I am making the video. So in this video, I am not going to show you any chart. This is the conceptual video. Okay. So as you know, you have step one, which is high volume rally, step two, which is low volume consolidation, and step three is a high volume breakout. So there are 8 points in this base. I have marked this here. Point number seven is our buy price. Okay. What my student was doing is, she would buy after she would mark the yellow line, she would mark another yellow line 1% below the first yellow line, and then she was planning to buy the stock in that range. Well, that is not correct. I helped her realize that once we draw this original buy price, then we need to draw a yellow line on top of that buy price, which is 1% above the first yellow line. This is the buying range. So if you are making that mistake, like you draw a line here and you draw 1% below, that is not correct. Okay, if you are buying it in this range, you are buying the stock prematurely. Okay, this is the correct buying range. You have to buy the stock in this particular 1% range. Okay, and zero point 0.7, zero point 0.5, zero point 0.3, 0.1, these are your buy points. But in this case, zero point 0.7 is the lowest. That is why 0.7 becomes our buy point. When you buy the stock, obviously, you're going to get a buy price from your broker. That is called as your average execution price. When the price enters that yellow band, you're going to get that average execution price. Only your broker can provide you that price. Okay. I call it the average execution price. This is where you will end up executing your trade. The moment you get that average execution price, you have to draw a 8% line. That is your hard stop loss, which is 8%. It is 8% below this pink line. The pink line is your average execution price. Okay. So what I do is, once I get the average execution price, I immediately draw a 8% line, which is the red line, 8% below the pink line. That is my hard stop loss. Now that stop loss is only for emergency purposes. Okay, that is not my real stop loss. Okay, although in my broking account, I will keep this as my hard stop loss. That's my GTT sell order. But mentally, I am probably tracking the point number 8, because this could be like 2-3% below the average execution price, if the stock, instead of going up, if it is breaking or undercutting this low, which is point number 8, probably the setup is failing, right? So mentally, I might be watching this, but practically speaking, my stop loss is at 8% level. Okay. And if it's if the market conditions are weak, I might not keep the stop loss here. I will just keep it here, the hard GTT sell order. Okay. That's one thing I wanted to convey here. Please buy properly. Don't make mistakes. Okay. Number one. Number two, volume. Next day, when the price starts to move from here, it hits your yellow line. Obviously, the volume is not going to be above average on the daily time frame chart, because on the daily time frame, the volume is just picking up. Let's say in the first half an hour, price hits the yellow line, correct? At that time, the volume will not be above average. It will not be above the blue line. Okay. So in that case, what I do is I go to the lower time frame chart, the 15-minute chart, 5-minute chart. I look for that candle to close within the yellow band, okay, on high volume on the 5-minute or the 15-minute chart. If that happens, if there is a close inside the yellow band on above average volume on the 5-minute and the 15-minute chart, that's a buy signal for me. Okay, that is how I end up buying the stock gradually. I make gradual purchases. So out of 100, I might buy 35 shares, then another maybe 30-40 shares, and the remaining. All of that is happening inside the yellow band. So ultimately, I will get the average execution price. I'm looking at price, I'm looking at volume on the 5-minute and the 15-minute chart. Okay, if I buy, let's say, 35 shares, after that, if the price and volume uh, don't pick up, then I'm not going to buy the remaining 65 shares. Okay, that is to control my risk. Another point to remember is that if I draw the base like this is a violet color, I have drawn this base. Okay, to draw the base, you need only 2 points. This is point 1 and this is point 2. These are the only 2 points you need to draw the base. And remember, this dotted line is the midpoint of the base, the height, take the midpoint. Your ultimate yellow line should be in the upper half of the base, not the lower half of the base. Why? Because of overhead supply. You want to buy it in the upper half of the base. Again, this upper half I divided into two zones, the green zone and the blue zone. Like for example, if you look at the Tesla base, which I showed you in my previous video, the red zone is the lower half of the base. The green and the blue constitute the upper half of the base. The green zone is less risky than the blue zone. Okay. And remember what I have been teaching. If the yellow line is in the blue zone, I expect at least 6 points in the base. If the yellow line is in the green zone, I expect at least 4 points in the base. Another point that I have mentioned is if the yellow line is in the green zone, I want the gray dotted line, which is the closing price, to be preferably in the green zone. Okay, that's tightness in price. Similarly, when yellow line is in blue zone, I want the closing price also to be in the blue zone. That again indicates tightness. Okay, so these are little nuances that you need to understand. That is why I am making this video. I realized that there is some confusion in the minds of my subscribers and students. So that is why I made this video, to clarify this thing for you. Just to quickly repeat, first you mark the points correctly, then you mark the yellow line, then don't draw a line below the yellow line, draw it above that buy price like this. And then when volume and price pick up on the lower time frame chart, you buy the stock. Okay, you will get an average execution price. Buy gradually, don't put all 100 shares order in one go. Okay, depending on whatever your position size, just count the number of shares. And the moment you buy, the first thing you have to do is to keep that 8% stop loss, because you never know what might happen in the market at any point in time in the day. Okay, somewhere some event, global event happens and suddenly everything crashes. You don't want a capital loss to exceed beyond a certain limit. So the moment you get the average execution price from your broker, put that hard GTT sell order at that red line. That red line is 8% below the pink line. It is not 8% below these yellow lines. Okay, it is 8% below the pink line because your average execution price is the price that you got, and your total stop loss should be 8%. Again, that is for emergency purposes only. Mental stop loss could be point number 8. Okay. Next, the buy point or the yellow line should be in the upper half of the base. I hope I have made this point clear. Don't make this mistake. Okay. Buy it properly. While buying, you might get a smaller time window. You might only get 5 or 15 minutes to buy the stock while the stock is hovering inside the yellow zone. But when it comes to selling, you draw two green lines, one at 25%, one at 20%. You get the green zone. The stock might stay for a while in that green zone. There you get a chance to sell. So the selling window is much larger when it comes to time span. The buying window is much smaller. And let me repeat it again. I have said this many times. If you buy the stock below the yellow line, you are buying it prematurely. If you buy the stock above this yellow band, that's an extended stock. So don't buy a stock which is premature. Don't buy a stock which is extended in price. Buy it properly in that 1% zone. Uh, there, the probability of big loss will be small because you're not buying a stock that is extended. So learn the 3 steps. Step number 1 is high volume rally. Step number 2 is low volume consolidation. Step number 3 is high volume breakout. Mark your buy point, mark the 1% band, get the average execution price, put the 8% stop loss, keep your mental stop loss somewhere over here. Okay. And then manage the trade. Okay. That is what we are supposed to do as traders. Last point before I end the video. Generally, there are not 8 points in the base. 90% of the time, you will see 4 points or 6 points in the base. 8 points are very rare. 10 points are the rare of the rarest. Okay. 8 points you might see once in maybe 2 months, 3 months. 10 points you will see maybe once in 6 months or something like that, or once in a year. Okay. So these are very rare uh, formations, but when you get those formations, the upside could be very high because the retail supply has shrunk so much that even a little uh, demand from institutional investors might push the stock price up. There is a difference between retail supply and overhead supply, which I have explained in my previous videos. You need to understand both of those concepts to execute the trade properly. Okay. So thank you so much.